Morning, everyone. Welcome to our spring tax update. My name's Aaron Hemmington, tax partner in the Northampton office of Horsons. And today I'm joined by my colleagues Stephen Charles, Craig Walker and Ben Harris. And today we're going to look at the various tax changes that have arisen in the last year or so. As the great Albert Einstein once said, the hardest thing in the world to understand is tax. Therefore, we'll try to keep it simple. But if you have any questions, please send them to us using the Q&A functionality, and we'll endeavour to answer them. Also, we'll be recording the webinar, so if anyone would like a copy, please do let us know. Slide, please. Okay, so for those of you that are new to Horsons, we're a leading independent firm of accountants and business advisors. Full service firm, basically dealing with audit, accounts, payroll, tax. Offices in Sheffield, Doncaster and Northampton with a strong focus on advisory services. And this year we're celebrating our 170th anniversary. So in terms of the order of play today, I'll be covering corporation tax and capital allowances. Ben will cover R&D, tax relief along with that and national insurance. Stephen's going to cover personal tax and Craig will cover property tax and employment tax. Okay, so just kicking off with corporation tax and corporation tax rates. So just to give you a bit of the background, the rate of corporation tax on all profits have been set at 19% since around 2017, which was a really sort of competitive rate in terms of other rates that we see around Europe and around the world. But on the 1st of April 2023, this all changed and we've now moved towards a tiered system. So you can see a summary of how that works on the screen. So a company that's got profits of up to 50,000, well, all those profits will be taxed at 19%, which is the small companies rate. Companies that have got profits within the sort of margin between 50,000 and 250,000, well, the situation is a little bit more complex for them. Broadly speaking, the first 50,000 of profit will be taxed at 19%, and the balance of profit over the 50,000 is taxed at a marginal rate of 26.5%. So in that sort of scenario, if you've got profits in that sort of bracket, it may be more beneficial to look at paying bonuses or making additional employer pension contributions to reduce that profit down and mitigate that marginal 26.5% rate. So for companies where profits exceed 250,000, then in that situation, all of those profits will be taxed at the 25% rate. It should also be noted that these thresholds are divided by 1 plus the number of associated companies. But broadly speaking, associated companies are companies that are in the same group of companies and companies that are under common control. And there's a raft of legislation which sort of deals with how you ascertain that, which is sort of beyond the scope of what we're discussing today. So where does that leave us in comparison to other European countries? Well, the average corporation tax rate in Europe is about around 21%. The highest rate at the moment appears to be in Malta. They've got a rate of 35%. And the lowest is in Hungary. They've got a rate of just 9%. The likes of France have a rate of 25.8% and Germany have a rate of about 29%. So our rate is now sort of above average, but it's still sort of 10% below the highest, and it's competitive with the other major economies such as France and Germany. Slide, please. So now moving on to capital allowances. First of all, let's look at the annual investment allowance. But the annual investment allowance has been with us since 2008, and it's available to sole traders, partnerships, and companies regardless of size. And the way it works is it provides 100% relief on purchase of qualifying plant and machinery and integral features up to a specified limit. You might wish to note that the AA doesn't apply to cars. There is a 100% first year allowance available for new electric cars, which may be worth looking into if something you're interested in. The specified limit of the annual investment allowance has stood at £1 million since 2019. And this was initially set to be a sort of temporary limit. This is actually very high compared to the limits when it was first introduced. I think it was about 50,000 when it first introduced in 2008. and did go as low as 25,000 in 2012. So as I said, that 1 million limit was set to be temporary, and it was set to reduce to 200,000 from April 23. But last year, the government have announced that they're going to set the AIA at 1 million on a permanent basis, which is good news. It should also be noted that that 1 million limit is shared between group companies or between related businesses where certain criteria are met. Next slide, please. Okay, so the super deduction was introduced in 2021 in the midst of the pandemic. I think it was aimed at trying to stimulate capital expenditure because the statistics showed that UK business investment accounted for just 10% of GDP compared to the OECD average of 12.5%, sorry. So they're really looking at trying to get sort of capital investment boosted. However, when it was introduced, it was only available to companies. Broadly speaking, the way it works is that it gave a 130% first year allowance on the purchase of new qualifying plant and machinery, which whilst the corporation tax rate was at 19%, gave an effective tax saving of 25%. A lower 50% first year allowance was available on special rate expenditure, such as integral features in buildings and long life assets. With the increase in the CT rate to 25%, the super deduction was abolished from April 2023, so it is no more. Should be noted if you've got an accounting period that's straddling 1st of April 23 and you've got some expenditure arising before that date, then the rate is apportioned, so it will be at a rate less than 130%, so just be aware of that. So with the abolition of the super deduction, we've now got full expensing. The next slide, please. So full expensing was initially introduced from April 2023 as a temporary measure to replace the super deduction effectively. It was actually set to expire at the end of March 26, but in the autumn statement, in the 2023 autumn statement, the government announced that full expensing would be made permanent, which is good news. So how does full expensing work? Well, quite simply, it provides a 100% first year allowance on the purchase of new qualifying plant and machinery, and a 50% first year allowance on special rate expenditure. It's important to note that this is actually uncapped, and as with the super deduction, it only applies to companies. The usual sort of exclusions do apply to cars and assets bought for leasing, but the government is currently consulting on introducing legislation to make this available to assets bought for leasing at some point in the future. Next slide, please. So electric vehicle charging points. So the 100% first year allowance has been available for electric vehicle charging points. It's installed at workplaces since about 2016. This was originally set to expire in March 23. Last year, the government have extended this first year allowance to 2025, giving companies and businesses more time to get them installed. And obviously, hopefully, to encourage people to use electric vehicles in line with the government's environmental sort of policy. So I think, yeah, something that should be looked at. It's a good way of providing tax efficient benefits because no benefit in kind is levied if a company car is charged at work, or if an employee charges their own car at work, provided that the charging points made available to all employees. Next slide, please. So just a little bit about free ports and investment zones, which were introduced a few years ago. Basically, this regime allows businesses in specific locations to benefit from a number of reliefs, including stamp duty land tax relief on the purchase of buildings, enhanced capital allowances for structures and buildings, and secondary class 1 NIC relief for eligible employees. So this regime was originally due to expire in 2026. It's now been extended to September 2031. So if you're involved in a business or you know of businesses that are located in any of the free port locations, definitely something that's worth investigating. There's some good tax incentives there. So I'm now going to hand over to Ben to talk about R&D. all the changes relating to that have come around in the last year or so, together with some VAT points and national insurance changes as well. Thank you.
Thanks, Aaron. So yeah, good morning, everyone. So there's been a lot of changes to R&D in the last year. So from the 1st of April 2023, there were significant changes that were made. So I'll go through a few of them now. The SME rate for additional tax deduction was reduced from 130% to 86%. Now, where the accounting period actually straddles the 1st of April 2023, there needs to be a pro rata split between basis. And if the rate at which the loss arising for R&D tax relief for be able to surrender for a tax credit was reduced from 14.5% to 10%. Now, if the company is considered to be an R&D intensive company, it can still continue to claim that 14.5% tax credit. The categories of expenditure that were qualifying for R&D expenditure actually expanded to include costs on data sets, cloud computing services, and costs of pure mathematics. The RDEC scheme as well, the tax credit increased from 13% to 20%. Again, this needs to be pro rata split if it straddles the 1st of April 2023. Some of the sort of bigger changes that were brought in to tackle non-compliance included the additional information form. Now, this is required to be submitted prior to including the R&D claim in your corporation tax return, and it needs to be made digitally. So this form needs to provide extensive details on the projects themselves, even if this is the 2nd or subsequent year of the project. For accounting periods beginning from the 1st of April 2023, the company needs to notify HMRC within 6 months of the end of the accounting period of its intention to file an R&D claim, unless a claim has been made in the previous 3 calendar years before the claim notification deadline. So if this notification isn't made, you won't be able to make an R&D claim. So it's important that this notification is made. If the R&D claim is made before the deadline of the claim notification expiration date, no separate claim notification is required. I think the main thing that's coming up from April 2024 is the merging of the SME and RDEC schemes. And I couldn't help but do a corny pun about Spice Girls song "When Two Become One." So I thought I'd just mention that here. So yeah, these 2 schemes are going to merge from the 1st of April 2024, and it's sort of seen a way of tightening up the rules and sort of making it less attractive and trying to allow for fewer claims to be made. Careful attention does need to be made because there is also going to be a separate scheme for R&D intensive companies. So what sort of changes are going to be made? Well, the merge scheme will provide profit-making companies with an R&D tax credit of 20%, which is the current RDEC rate. R&D intensive companies, SMEs, will continue to surrender losses for a tax credit of 14.5% compared to a reduced rate of 10% of the SMEs. Previously, in order to be this R&D intensive company, at least 40% of the qualifying R&D expenditure needed to be 40% or more of the total company expenditure. However, this is going to be reduced to 30% for periods beginning on or after the 1st of April 2024. So it's going to be important to sort of track the expenditure that's being incurred, because if you're able to prove that you are R&D intensive, you're going to be able to get higher tax relief, tax credits. SMEs, which are not R&D intensive, will not be able to claim the additional deduction as well, whereas the R&D intensive companies will continue to be able to claim, the SMEs, sorry, will be able to continue to claim 86% additional deduction. One of the main ones as well that's come out is that the rules as to who can claim for subcontracted R&D will be changed, and relief will actually be given to the company who is deciding that the R&D is needed. So this will mean that larger companies will be able to claim for R&D that they are specifically subcontracted to any party, including SMEs. An SME to which R&D has been specifically subcontracted to from a large company will not be able to claim relief. Now, under the old arrangements, it could generally claim the RDEC where it's subcontracted from a larger company. The current subsidised expenditure rules in the SME regime will be removed. So if a company receives a grant to cover the cost of the R&D project, this will not reduce the amount of relief that's available. And this has been sort of a litigious point for many years, so it should provide clarity going forward. Where a company is loss-making, there's generally a cap on tax credit available for both SMEs and large companies, which is called the POA National Insurance Cap. And what the merge scheme is actually going to do is going to adopt the more generous cap compared to the large company scheme, which is going to benefit larger companies who were restricted previously to 100% of the POAE national insurance liabilities. Out of the budget came a very important point that HMRC is seeking to establish an expert panel to support the administration of the scheme. And it's been reported through the news that, there was a lot of agents that are struggling to speak with HMRC because a lot of the experts weren't being advised as to sort of the advancements that were being made. So this is going to be good going forward so that HMRC and the agents and the claimant companies have clarity on what is going to be an advance in science or technology. Next slide, please, Rob. So HMRC are stepping up scrutiny to tackle non-compliance and sort of tighten up the rules to who can actually make the claim. So what can you do to submit a robust claim? Well, you can start to gather evidence early to support the claim. So you can start looking at timesheets, diaries, board minutes, testing documentation, scientific journals even to sort of show the knowledge gap in the industry. It's not possible anymore to simply just estimate your time. You need to be able to provide substantiated evidence to HMRC should an inquiry be raised by them. The records need to show that the start date of the projects and the anticipated end date or a defined point at which the project will end. Who was involved with the project, how long, and HMRC are looking for time periods now, so May to December, for example. The additional information form, as discussed previously, is a big crackdown that HMRC are looking to use. Up until August 2023, it was possible to just make an R&D claim by including the figures on the tax computation and return. The best practice has always been to do a report and explain why an advance has been made in science or technology. However, agents in the past were submitting claims to see on the let's see what happens basis, and we're only seeking to justify a claim if they were challenged by HMRC. Now, it's not possible to do this anymore. Right, so you should be able to demonstrate to HMRC why an advance is being made. So this is why you should be getting expert advice to make sure you're not falling foul of the rules. And the main thing as well, don't forget the claim notification as described at the bottom of the slides, because if you don't make the notification, you're not able to make the R&D claim in time. So you're looking at, the claim notification is really important for those new startup companies that have just recently started to make a claim. Next slide, please, Rob. Cultural tax reliefs. So theatres, orchestras, museums in the UK currently benefit from an enhanced tax relief by way of an additional deduction for qualifying expenditure that's been incurred. To support these industries as it recovered from the economic impact of COVID-19, the Finance Act 2022 temporarily increased the rate of payable tax credit for cultural tax reliefs. Now, relief is given by way of an additional deduction equal to lower of 80% of the qualifying core expenditure and qualifying expenditure and goods or services that are provided from the UK or EEA. Now, as described on the slide, from the 1st of April 2024, there's going to be some restrictions that will be placed on European expenditure that's been incurred. Now, if the company is profitable, tax relief can be given by helping to reduce the taxable profits and therefore save a corporation tax. Now, if you make a loss, some or all the loss can actually be surrendered for a payable tax credit. Now, the rates were due to be tapered down from April 2025 to between 35%, and then return to the original levels from the 1st of April 2026, with museums and galleries tax relief expiring at this date. However, the spring budget announced that there was going to be a permanent extension of this tax relief available for the companies. So, and it increased, the new rates on the slides there. So, for example, theatre tax relief for non-touring companies from the 1st of April 2025 will be 40% compared to 45% if the production is touring. And the museum and galleries relief has also been made permanent as well. From the 1st of April 2024, all claims need to be accompanied by an additional information form. which is very similar to the R&D tax system. So you need to provide information such as the date the production phase began, what was the opening act performance, how many performances have been done during the accounting period, and then you also need to provide information on the total expenditure of the productions. Next slide, please, Rob. So the government's recently established a new tax relief regime for film production companies called the Audiovisual Expenditure Credit. And so this is sought to replace the film tax relief, high-end TV tax relief, and children's TV tax relief. And this is sort of the expenditure that's incurred on film, high-end, and TV programs. So from the 1st of April 2024, tax relief is going to be given through this tax credit. Prior to this, relief was given by way of additional deduction from profits or surrendering a loss. And now it's just provide the tax credit instead. Now, the tax credit for film, high-end TV is generally eligible for a credit rate of 34% on qualifying expenditure, whereas animation and children's TV is going to be eligible for around 39%. But what was announced during the spring budget is they have decided to introduce this independent film tax credit. And the idea behind this is that if a film can show that they meet this new test set by the British Film Institute and has core expenditure of £50 million or less, then it's going to get a much higher tax credit of 53% of qualifying expenditure. Now, companies will generally be able to use the current system until 31st of March 2027, but companies can now opt in for accounting periods on or after the 1st of January 2024. But from April 2025, all new productions need to be underneath this scheme. And then it will all companies will then need to be within this new scheme starting from the 1st of April 2027. The video games expenditure credit has also been introduced, which is seeking to replace the video games tax relief system currently in place. And this is seeking to provide a tax credit of 34% qualifying expenditure. So, however, as is above the line credit, and if, say, the company has a corporation tax rate of 25%, it's going to have an effective tax rate of 25.5%, which is just sort of a slightly modest increase from the video games tax relief system. Prior to the 1st of January 2024, very similar to the audiovisual expenditure credit, whereas it used to provide an additional corporation tax deduction or a tax credit. And the same transitional rules are going to apply to the video games expenditure credit as from the audiovisual expenditure credit. What's very interesting is that the government has elected to scrap the subcontracting limit set at £1 million, which is going to be welcome news to a lot of individuals in the industry for this new video games credit, as you know, it previously limited the amount of expenditure that could be claimed. But a lot of the things have stayed the same. So the 8% cap on qualifying expenditure stayed the same. The cultural test has stayed the same. But there are going to be some changes regarding that expenditure must be used and consumed in the UK. And I think that the government are going to be announcing consultations on this shortly. Next slide, please, Rob. So VAT. So the business is required to register for VAT whenever their turnover exceeds the VAT registration in the past 12 months, or you know you're going to exceed that threshold in the next 30 days alone. Now, this is currently set at 85,000. However, the government announced during the recent spring budget from the 1st of April 2024 that this registration threshold is going to increase to 90,000, up from 5,000. And the threshold that affects when an application can be submitted for a deregistration of VAT will increase to 88,000. Now, this VAT threshold applies to any 12-month period and not just your accounting periods. So you need to keep a good monthly record of the turnover of your taxable supplies on a rolling basis to justify the reason for registration or non-registration for VAT. There's another brief point is that the government has announced that they are seeking to provide HMRC with additional powers to check the validity of VAT refunds for DIY builders. So this scheme allows for non-VAT registered individuals building their home for residential purposes to submit a claim. to recover the VAT that they incurred during the construction process. Now, currently HMRC don't have the power itself to require claimants to provide additional information such as invoices, but now this additional power will now provide HMRC with that power. And I think it's to do with sort of tackling non-compliance in the claims. Next slide, please, Rob. National insurance. So it was announced in the recent spring budget, the government has made further reductions in national insurance rates. Now, the primary threshold, as stated on the slide there, for Class 1 employee NICs remains at 12,570, and this is going to continue to do so until April 2028. With effect from 6th of April 2024, the main Class 1 employee rate will reduce from 10% to 8%, which represents with a tax saving of up to £754 per year. This spring budget actually follows on from the autumn statement, which said that the main employed NIC rate was going to reduce from 12% to 10%. So this additional reduction is going to present some challenges to payroll software providers to update their systems. So employers need to make sure that this is in place for the new tax year starting from the 6th of April 2024. It is important to say that the 2% further cut will only apply on earnings between 12,570 and 50,270, and not the amount above this. This will still remain the same, and the amount above 50,270 will stay at 2%. Employers, unfortunately, don't have equivalent reason to celebrate, since the rate of Class 1 employers' NICs on earnings above 9,100 is going to remain at 13.8%. Next slide, please, Rob. Thank you. So self-employed individuals, the main Class 4 NICs, it's going to be reduced from 9% to 6% from the 6th of April 2024. Instead of the proposed 8% from the autumn statement. So the spring budget 2024 is actually going to supersede the autumn statement. So in effect, you know, although it was published as though it was going to be 2% cut, it's actually a 3% cut. So for Class 2, in the 2023-24 period, Class 2 was payable at £3.45 per week for those with profits more than the lower profits limit of 12,570. But what the spring budget has announced, it was announced in the autumn statement 2023 that Class 2 would no longer be mandatory from the 6th of April 24, which represents additional tax saving of around £179 per year. As is often the case with tax, there's more to it than just the headlines. Self-employed individuals who would otherwise paid Class 2 NICs will still be given the national insurance credit, so for example, state pension, as if they paid the charge itself. And Class 2 NICs will still exist, but primarily to allow self-employed individuals with profits below the lower profits limit to make voluntary contributions. So these individuals, for example, with profits below 6,725 will see no changes, but they'll have the option of paying Class 2 NICs in order to build up their entitlement to state pension. The government has stated that it's going to consult on further reforms in Class 2 NICs with the goal of abolishing it. We've not heard anything further from this as of yet. There's no changes to Class 2 NICs, Class 3 NICs, and the employment allowance is set to stay at 5,000 for each tax year. But now, I'm going to hand you over to Stephen, who's going to take you through some of the personal tax changes. Thank you.
Good morning, everyone. Thanks, Ben, for that. So just a personal tax update, really. Just on tax rates and tax bands, it was announced a little while ago that personal allowance and tax bands were going to stay the same, which sort of seems like it's not news at all. Nothing's changing, but it does have a big impact on the amount of tax people are paying. So these rates being frozen till April 2028. Of course, if we have a change of government, then that could change. But at the moment, that's what we're looking at. So these changes came in a year or so ago. So, 5 years of no change on this, it does have a massive impact on the amount of money the government collects. It's the ultimate stealth tax, if you like. Also last year, in the current tax year, we had this change from the threshold for the 45% tax rate. So that came down from 150,000 to 125,140. The rather odd figure of 125,140 is because that's where you finish losing your personal allowance. The personal allowance is fully withdrawn at that amount. Dividend allowance is also reducing. Again, this is a trend really. Dividend allowance was originally £5,000, came down to 2, now it's 1, and it's going to go down to £500. So yeah, that's disappointing news really for those with investments. Thanks, Rob. So interesting news on the high income child benefit charge. We're seeing a lot of tax cases going through at the moment, so people not paying the high income child benefit charge when they should do. So just to recap on that, that's when salary goes over £50,000 or income goes over £50,000, you have to pay back some of your child benefit. It's a nasty sort of tax trap, and that 50,000 has remained the same since it was introduced quite a few years ago now. So long overdue, but that 50,000 is being pushed up to 60,000 from next month. But that's good news, definitely. So hopefully fewer people will get caught by that going forwards. The Chancellor also suggested that he's going to move to a household basis, so looking at household income rather than individual income. So at the moment it's based on the higher earner in the household. It's very difficult to see how the household basis is going to work practically, so that's not going to come in for a couple of years. So it's going to take quite some substantial changes, I suggest, to the revenue systems to be able to collect that sort of information, because since the introduction of self-assessment many years ago, household income hasn't really been terribly relevant. It's all been on a self-assessed individual basis. So that's a major change the government's looking at. Thanks, Rob. So the big news in the budget was non-doms. So taking away some of the tax advantages for non-domiciled individuals. So in the past, a non-dom could benefit from the remittance basis of taxation for up to 15 years. So the remittance basis meant that they could only pay tax on overseas income and gains when they brought those income and gains to the UK. So he's changing that system, getting rid of it completely, which has been around for an awful long time. He's moving to a residence-based system. So going forwards, for the first 4 tax years of residence in the UK, an individual won't pay tax on foreign income and gains, but after that, they'll be taxed on their worldwide income and gains. I mean, people think that might have a massive impact on very wealthy individuals living in the UK, and they might see people relocating overseas. So we'll have to see if that is the case. But it's really, I suggest, a politically driven decision. Labour had said they were going to do that anyway. So basically the Conservatives have stolen Labour's thunder. There's also an announcement about new ISA allowance for UK focused assets, and we'll have to see what that brings. Thanks, Rob. Making tax digital, this has been delayed for a little while, so we've got a little bit more time to plan. So that's not coming until April 2026. Trying to harmonise the penalty regime for income tax and VAT. This has come in now for VAT and has been positively received, I think. And so the income tax penalty regime will be moving towards to be similar in a year or two's time. Thanks, Rob. This is a major change for some businesses. So since self-assessment came in, individuals, sole traders and partnerships have been able to choose whichever year end suited them. I think recently most sole traders have gone for a March year end, but we still see quite a few professional partnerships which don't have a March year end, and certainly sole traders who have been trading for a long time often don't have a March year end. So the government's got a bit fed up with that, so they are moving to an actual basis. So for the current tax year, the actual profits have to be taxed. So for those without a March year end, there's a sort of a catch-up charge, and that catch-up charge can be spread over up to 5 years. So we'll have a cash flow impact on those businesses affected, but yeah, as I say, apart from professional partnerships, we're not seeing a huge number of businesses which are going to get significantly impacted by these changes. But it will, I think it will make the system simpler going forwards. At the moment, we have quite complicated opening and closing year rules for non-March year ends. So it is a bit of a simplification, but also raises some money for the government too. Thanks, Rob. Inheritance tax, again, another example of fiscal drag, stealth tax. The nil rate band has been at 325,000 for, well, since 2009 now. So if you think how much house prices have gone up in that time, that's really quite shocking, I'd suggest. But we do have the residence nil rate band, so that can top up the nil rate band by another 175,000 to take it to 500,000 if the main residence is left to direct descendants. So more and more people are getting caught by inheritance tax. Unfortunately, we are seeing more and more questions and concerns by our clients about it. Along with the remittance basis, there have been changes to, well, proposed changes to inheritance tax for those who are not domiciled in the UK. So generally, domiciled people pay inheritance tax in the UK on their worldwide assets, whereas non-doms only pay it on UK assets. So again, they're looking to change that. That's not final. It's still just proposals. So to move to a residence-based system. So if you've been resident in the UK for 10 years, you'll get caught by having to pay UK inheritance tax on your worldwide assets. A little bit of restriction. Agricultural property relief is now going to be restricted just to UK property. Now we're not in the EU, they can do that. They can focus it more on the UK. But no changes to business property relief and agricultural property relief more generally, which is good news. Still very valuable reliefs. Thanks, Rob. Some changes there, just more administrative changes to trusts, some slight simplifications. So that's been that's positive news, but again, probably won't make a huge impact on most clients. Thanks, Rob. Pensions. So I think this was a spring budget with very, very few announcements about pensions. I can't really remember any actually, which is quite unusual. They do love to tinker with pensions. So I think good news that no major changes this year. But just recapping on the changes which came in last year. So lifetime allowance was effectively abolished, which is great news really. The annual allowance has gone up from 40,000 to 60,000. You may remember there's a lot of pressure from NHS consultants and so on to raise that limit. And the money purchase allowance has gone up from 4,000 to 10,000. That's what people have started drawing out from their pensions. The level at which annual allowance is tapered has increased as well from 240 to 260,000. Again, a welcome change. And although the lifetime allowance has been abolished, the sort of tax-free lump sum you can take out has been capped. So that's the strange figure of 268,000, 275,000. And just a reminder that any amounts in excess of that tax to the marginal rate. So again, a bit of simplification and a bit of a tax saving. So welcome changes there. Thank you, Rob. Well, I think that's me done. So I'll just hand you over to Craig to do the last session. Thank you.
Thanks, Stephen. Yeah, good morning, everyone. I'm Craig Walker, Tax Director at Horsons, and it's my pleasure this morning to talk to you about changes to property tax and employment tax. So firstly, looking at property tax changes, there were 2 or 3 very interesting announcements in the Chancellor's spring budget. One of these related to the furnished holiday let tax regime. So this has been around for over 40 years now, and basically if you own a furnished holiday let, then you can claim there's four key tax advantages really, which aren't available to landlords of longer term lets. So it was announced in the budget that this is going to be scrapped from April 2025. It's been rumoured that one of the reasons for scrapping this is because with making tax digital coming in shortly, having two different kinds of property income creates a complication for the system. It's much easier just to tax all property income in the same way. So that's sort of one of the rumours as to why this change is coming in. So in terms of the key advantages that are currently available, the first one relates to the deductibility of interest. So if you own a furnished holiday let, you can deduct 100% of your mortgage interest costs, whereas that's not possible for longer term lets. So that can be a key income tax advantage. Another key advantage is that furnished holiday lets have access to some key CGT reliefs. So if you sell a furnished holiday let, you can potentially pay tax at just 10% on the capital gain. That's by virtue of business asset disposal relief. So lower than the standard rates that you would apply for normal property sales. So normally you'd pay CGT at 18% or 28%. It also allows you to potentially hold over the gain or roll over the gain into future purchases. So yeah, that's been a great advantage, which will be going. Another one is capital allowances. So if you have a furnished holiday let, you can claim capital allowances on plant and machinery purchases. So you can't always do that for normal property types. And then the fourth key benefit relates to pension contributions. So profits from furnished holiday lets will qualify as relevant earnings for pension contributions. So it does allow you potentially to pay a bit more into your pension pot, given that the profits do qualify as relevant earnings. Normally there's a restriction on how much tax relief you can claim on pension contributions, and that's capped at 100% of your relevant earnings. So there's 4 key tax advantages which are going, unfortunately, from April 2025. So we do have a year left of these rules. So I think the government's sort of hoping that some people will just decide to sell up, take advantage of the potentially 10% rate of CGT, and then that will help out potentially local people to get on the housing ladder. So it's coming in April 25. We're expecting that HMRC will introduce some anti-forestalling measures, basically to try and stop people accessing the CGT reliefs by using conditional contracts. So sort of trying to get around these rules. So yeah, that's quite a significant change. So that's been around for 40 years. So yeah, it's something that if you're a furnished holiday let owner, then yeah, no doubt you'll be very disappointed with that one. Next slide, please, Rob. Another key change as well in the recent budget was to do with the rate of capital gains tax paid on the sale of residential property. So at the moment, the rates that are payable are 18% and 28%. The Chancellor announced that the rate will be going down. The higher rate will be going down from 28% to 24% from April 2024. So if you're looking to sell in the next year or so, then that may save you some money there. The other thing to flag though is that whilst that rate is coming down from 28 to 24, the annual exemption is also coming down from April. So sort of so at the moment it's £6,000 per year. That's dropping down to just £3,000 from April 2024, and that's for all disposals, whether it's residential property or shares, whatever it may be. And that's been sort of steadily falling now for the last couple of years. One thing that often gets overlooked with property sales is the requirement sometimes to report the sale within 60 days of the sale going through. So I still think people aren't aware of this important requirement. So if you're a UK resident individual and you sell a UK property and make a gain on that, you need to not only report the sale within 60 days, but also pay the CGT that's due within 60 days. So that can be quite an onerous requirement. The 60-day deadline also applies to non-UK resident owners of property, whether it's residential property or commercial property. So it's important that you meet this deadline. Just in terms of non-UK resident owners, it's a slightly different method for calculating the CGT. So just be aware of that. And the final thing to note in terms of capital gains tax is that last April 23, it was announced that separating spouses now have up to 3 years after the tax year in which they cease to live together to make no gain, no loss transfers between themselves. So that extended the time period up to 3 years. So that may be helpful to some. Next slide, please, Rob. Again, in the budget, we had an announcement affecting property tax in relation to multiple dwellings relief. So multiple dwellings relief has been around since 2011 and applies to stamp duty, land tax. There's been a consultation on whether to tweak the rules or abolish it altogether. I think that was in light of a number of recent court cases concerning multiple dwellings. The government's taken the decision, let's just abolish the thing. I think they saw that well, there was perceived to be fraud within some of the claims, so they decided to just scrap that. And that will save the government quite a lot of money, actually, more than I thought. That some estimates are sort of saying that's going to be about 800 million, that potential saving. So that's going from the 1st of June 24. And the other thing to note in terms of stamp duty, land tax is that there's a slight tweak to first-time buyer relief. So this change is basically to remedy an anomaly in the current rules. So the first-time buyer relief will be extended to individuals buying a new residential lease via a nominee or bare trust arrangement. So going forward, the individual, not the bare trustee, will be treated as the purchaser. So that's coming in shortly. Next slide, please, Rob. So moving on to employment tax. I'm conscious of the time, so I'll try and whiz through some of these. Firstly, looking at cars, company cars. So you'll be pleased to know that the rates of tax for the company car benefit remain frozen for 24-25. And also a key thing to flag as well is that if you look at the first bullet point there, the rate of tax that's payable on a fully electric car, just 2%. That was the case last year. That's going to be the case for 24-25. So really low rates of tax for company car owners with electric vehicles. That is going to increase slightly over the next 3 years. We're looking at increases of 1% each year. So going up to 3%, 4% and 5% over the next 3 years. There'll also be a similar increase of 1% each year to cars with emissions below 75 grams per kilometre. So we're looking there really at hybrid type vehicles, so that they will go up a little bit as well. For cars with emissions of 75 grams per kilometre and more, there'll be a rise of 1% in 25-26. So yeah, electric cars, obviously very low rates of tax for the employee. Also, as Aaron alluded to, there's some tax perks as well for the employer. So the employer can often claim 100% tax relief in year one when the company car is acquired. Can also claim tax relief on the costs of installing the charging points. So it sort of works well for employees and employers. Can lead to large balancing charges when the cars are sold, but again, that's not really an issue if you then acquire another electric car. Electricity is not a fuel for benefit in kind purposes. So normally, if the employer is paying for private fuel, then there is a fuel benefit charge. That's £27,800 times the relevant percentage. that threshold hasn't changed. It isn't changing for 24-25. That will remain 27,800. But as I say, yeah, for electric car purposes, electricity is not a fuel. If the employee charges the company car at home, they're able to reclaim 9p for every business mile undertaken. Try to keep good records there to justify the claims. Alternatively, they can reclaim the specific cost incurred by the employee for business mileage. So the simplest way to do it is 9p per mile, but it is possible sometimes to justify a higher rate. If you own the electric car privately, then and you undertake business mileage, then you can potentially claim back 45p per mile, up to 45p per mile from your employer without any tax implications. So that's the same rate as petrol and diesel cars. Just something to flag there. Next slide, please, Rob. Company vans. So if your employer provides you with a company van for private use, you will suffer a tax charge on that, benefit in kind charge. It's a fairly low rate really compared to the rates applying to cars. So for 23-24, the van benefit was £3,960. That's staying exactly the same for 24-25. If the employer provides free fuel as well for private journeys, then there is also a benefit in kind charge of £757 for the fuel element. One thing to flag is that if you have a zero emission van, and there are a lot of them about now, there's no taxable benefit in kind. So this has been the case since April 2021. It seems a very generous tax break. So yeah, if you think you might potentially be able to benefit from that, then you look into that further. So it's extremely generous. So that's looking at company vans. There was an interesting case last year involving Coca-Cola, where the courts had to decide whether something should be taxed as a van or a car for benefit in kind purposes. I think for you and I, if we were to look at the vehicles in question, we would probably think they were vans. They were a Vauxhall Vivaro and a VW Transporter van. So from the outside, look like vans, so you'd expect them to be taxed like vans. HMRC took a different view. They argued that they were not goods vehicles at all, and they should be taxed as cars for benefit in kind purposes. So with the vans in question, they had been modified. So some of the seats had been moved around, the windows had been changed, some racking had been added. So it just depends on the particular circumstances, but certainly something to watch out for if you do have a company van. In the future, HMRC might be looking at that more closely and saying, actually, we think it should be taxed as a car. Last month there was an announcement by the government regarding double cab pickup trucks. You may have seen this in the press. So it was announced that double cab pickup trucks would be taxed as cars for benefit in kind purposes. And there was a little bit of uproar from I think the motoring industry and particularly farmers. So we saw a U-turn on that announcement. I think it was less than a week later. So that will not go ahead. So double cab pickups for now are taxed as vans, provided the payload is more than 1 ton. Next slide, please, Rob. So in the recent budget, the government announced a number of simplifications to the tax system, and a couple of these related to employment tax. So the first one is to do with forms P11D. So if you receive any benefits in kind from your employer, whether it's a company car or private medical insurance, you'll probably be familiar with P11Ds. you receive one at the end of the tax year saying what the benefit in kind is for having that particular perk. It's been decided that we're going to scrap that system. So from April 2026, benefits in kind will be reported through the payroll in real time, and the tax and NIC due on those will be collected through the payroll system. So that's quite a big change. I think P11Ds have been around since the 1960s. Certainly something I've always it's been there throughout my career in tax. So yeah, big change to the system there, and we're waiting to see exactly how that's going to work in practice. Another thing that was announced as well in the recent budget was in terms of employees claiming tax relief on expenses. So at the moment, I think HMRC said they receive about 1.1 million claims each year from employees seeking additional tax relief on expenses they've incurred. And a lot of those claims have to be dealt with manually by HMRC, which they don't want to do. They'd rather have a sort of sleek online system for doing that. So they are going to design a new online system that will allow employees to claim tax relief on expenses incurred. So hopefully that will enable employees to receive the tax relief much sooner. So sort of a welcome change, I think. And further details will be announced on that later in the year. Next slide, please, Rob. So just finally on employment tax, just wanted to flag that from the 1st of April, the national living wage will be extended to 21 and 22-year-olds. So currently you have to be 23 or older to qualify. So that's coming in from the 1st of April. And also the rates are increasing quite significantly. So the national living wage is increasing from £10.42 up to £11.44. So that's an increase of 9.8%. Some of the other rates as well are seeing even higher increases. So the rates applying to 16 to 17-year-olds and the apprenticeship rate, that's an increase of 21% from this last year. So some quite significant increases there. Next slide, please, Rob. So yeah, I appreciate we've gone through quite a lot today in a short space of time. So I don't know if we've had any questions come through. I can't see any that have come through on the Q&A box, but if you do happen to have any questions that you want to raise privately with us after today's session, then our contact details are on the screen there. And yeah, we hope you found today useful. So appreciate we've had to rush through it at quite a pace because of all the number of changes. But have we had one question come in? Sorry, just a question on MTD I presume that's for income tax. Is MTD compulsory? The answer is yes. Yes, that will be compulsory. That's not coming in until April 26, but yes, it will be compulsory.
But subject to thresholds.
Subject to the thresholds, yeah. But yeah, eventually that's sort of coming in for everyone. Have any more questions? No. Well, thank you very much for joining us this morning. So I hope you found it useful and enjoy the rest of your day. Thank you very much.